What is going on, guys? Welcome to Celestin Capital, and in today's video I'm going to go over a simplified approach to Wyckoff because I believe that trading is very simple. Am I saying that trading is easy? Absolutely not. But I do believe that trading should be simplified to the point where it becomes second nature, right? We don't want to overcomplicate things. We don't want to make things more complicated than they have to be because, the market's already, I don't want to say the market's against us because that's a pessimistic way of looking at things, but you know, the market is not here for us to pull money from it. So if we want to pull money from it, we want to make things as simple and as relaxed and just cater it to our own understanding, cater it to our own personality, right? So what I'm going to teach you here is a simplified approach to Wyckoff. Over the past few months, weeks or months, um, I've been studying this new approach to Wyckoff. And you guys may have seen the video that I posted about Wyckoff a few weeks ago or a few months ago. And in that video, I showed you guys that you can use Wyckoff to anticipate a shift of structure. So if price is going up, you can use Wyckoff to anticipate move from an uptrend to a downtrend. It may not be a long-term downtrend, but you can anticipate a shift. That shift could be just a pullback in an uptrend, right? Or if price is going down, you can anticipate that price to go back up, and that can either be a pullback or a complete shift of structure. So I showed you guys, or I posted that video for you guys to watch. If you didn't watch it, I advise you guys to watch it. But in this video, this is going to be a much simplified version of that. So let's just take a quick look at the stock charts that every smart money trader seems to be looking at, right? So if you're in the smart money space, or if you've been trading for a while, you may have seen this you may have been on this website before. It's called Stock Charts. I'll link it down below if you want to check it out. But it's called the School of Stock Charts, and it gives us these different schematics, these different Wyckoff schematics, right? So we have accumulation and we have distribution. It gives you different phases of accumulation and distribution. So what I want to do is I want to show you guys how I've simplified my trading to the point where I don't need to label every single part of Wyckoff, every single piece of Wyckoff, because sometimes you may get confused if you're missing a part. Because let's say we have the sudden climax, then we have the automatic rally, but we don't get the ST, and we get an ST and B instead. Before, I would freak out and be like, whoa, where's my ST? I need to have an ST before this Wyckoff is valid. That is not the case, because we know that Wyckoff is just in itself is manipulation, right? Wyckoff in itself is just manipulation within the market. And I've come up with this simple approach to trading, or to trading Wyckoff, that I have written down here. Where is it? All right, here we go. So Wyckoff is just these four different topics, these four different ideas. So for one, we've got manipulation. I'm going to write here manipulation. Then we've got liquidation. And we've got breakout. And then finally, we have mitigation. That's all it is, guys. Literally, that's all it is. And I'm going to show you guys exactly what do I mean by that. Manipulation, liquidation, breakout, and mitigation. I'm going to show you guys exactly what I mean by this, and we're going to dive into the charts. I have examples right here that I'm going to show you guys. Now, these are cherry-picked examples, but the point is I'm trying to show you guys how the market moves, ways you can anticipate movements in the market. All right, even though these trades are cherry picked. These two trades that I'm going to go over are cherry picked, which means that they've already happened, and I just went back in time to look over them. You can find them useful going into the future and anticipating these moves happening again, because again, history repeats itself. The market is constantly going to repeat itself, and if you understand what I'm going to teach you here, you can take advantage of the market repeating itself. So, manipulation. Let's get into manipulation. As you know, the basis of Wyckoff is manipulation, or the basis of just the flow of the market anyway is manipulation, right? The market manipulates to anticipate or to induce buyers and sellers into the market. So whenever buyers and sellers get into the market, it's creating liquidity. which is just money, simply money. So you've got sellers and you got buyers into the market. Let's take a look at this distribution schematic first. I want to take a look at this distribution. So we have this PSY, and you can label them if you want, but I'm going to show you the simplified version in a sec. So we've got this manipulation happening. Now, what happens during this manipulation? We see that there's liquidations happening. So we've got the market makers enticing buyers and sellers into the market. So we have market makers forming some kind of support and resistance is what I mean. So we have this buying climax, this automatic rally, this ST, and then the market's liquidating these people out of the market. So those that bought here got liquidated with this move down here. Those that sold up here got liquidated with this move over here. Now here's where things start to get a lot simpler. If I can anticipate that price is going to go down or up, in this case, that price is going to go down, what I can do is wait for this UTAD to happen. And just so you know, the UTAD doesn't always happen. Sometimes it stops at the UT. What I can anticipate is for the UTAD to happen. And once I get a break of structure, I can anticipate a mitigation of that break of structure. So what exactly am I saying? Let's hop into the chart really quickly. So again, take a look at this. We're going to keep this in mind up here. I'm going to make sure this is in sight the entire time so that we don't lose sight of the essence of what I'm talking about here. So let's hop down to the 5-minute chart. As I told you guys, manipulation, right? The market is manipulating. So we have manipulation happening. So we've checked one box. Manipulation, check. Liquidation, right? I'm on 5 minutes. There we go. There we go. Here's the 5-minute. All right, manipulation, check. Liquidation. So those people that sold up here got liquidated with this move up here that had their stop losses right here. So if you were selling right here, your stop loss got hit up here, right? And you had your stop loss up here. You may have gotten stopped out with this move up here. So that's liquidation. Those that bought down here, let's say you bought down here, you were in this move right here, you got stopped out right over here, right? So we see this happening. We see this happening. You got stopped out right over here. So what am I saying? When you see some kind of manipulation happening, you can anticipate it's Wyckoff. And you can go ahead and label it if you want, or you can keep it as simple as this. So you see that this manipulation is happening, right? Then what do we get after the manipulation? We get manipulation, then we get liquidation. Sorry, this happened. Let me actually do this. We get manipulation, then we get liquidations happening, right? As I just showed you. Then we get the breakout. So the breakout happens when price shoots down or up. There's a huge momentum shift in price. So since we're anticipating that price is going to sell down, we want to anticipate a breakout to the downside, right? Because we're anticipating price is going to break down. So we're anticipating for price to shoot down. So we're expecting a breakout to the downside and a sell off of a supply zone. Now, where do we see breakouts happening? So we get a liquidation of this BC right here, right? This buying climax. Let's just say we couldn't see the left side of the chart right here. Let's say we couldn't see that right over here. We got the left chart, the left side liquidated, right? We liquidated, then we see a break of structure right over here. Let's say we got a break of structure right over here. BOS down. And then let's say we just decided to sell over here. Whenever price mitigated this supply zone right here. Last up move before the down move. Let's say we took the sell off of there. All right. The price broke down and we took the sell right over here. We got up right here. Stop loss right above this UT. So now we see that we got tapped into the trade, right? Then price went in our direction, right? We may have been break even at this point. For me personally, the way I manage my trade, I would have been at break even at this point. I would have been at break even at this point. And once price, let's say we were right here first, I would have been break even at this point with this candle. I would have probably broken even somewhere around here or here after price broke this low right here. So price came down, and then what do we see? We see another liquidation happening. Now this liquidation is a lot stronger because why? This liquidation is a lot stronger than this liquidation because in this case, we see this as liquidity high. Price closed above this high. So this liquidation is not as strong. But if we take a look at this liquidation over here, price did not close above this high, which is showing us that price does not want to go further up, right? Price does not want to go further up. So we see this huge liquidation in price. Liquidity high. We see this liquidation. And then what do we see? We see a breakout. Breakout, which is the third step in our 4-step process. We see the breakout. So we see the breakout to the downside. And then what? We see a mitigation of the last down move right over here. This last down move. You could have used this right here as the last down move, but I understand that the last down move doesn't always mean the last candle. If you zoom out to a higher time frame, this is actually the last down candle. This from here to here is the last down candle. So what do we get after we get a break of structure of this low right here? One sec. Take a look at this. So we see that this low was formed. Let's go back right here. So we're going to wait for price to break below this low right here, right? Liquidity or break a structure down. So price broke down. We broke down below this low, and we want to take the last down move, right? Remember, this for me is the last down move. You could have used this, but you would not have gotten tapped in. So let's say we took the sell off of here and stop loss over here, or you could have put stop loss above the wick to be extra safe. But I would have put mine right over here. So we're not tapped into the trade yet, right? Because we're waiting for the mitigation because we got the breakout. This is the breakout right here. Once price breaks structure to the downside, this is the breakout. So we have the manipulation, the liquidation, which is the strong wick right here, the liquidation, the breakout, which is the strong move down after the wick. You see, we get the strong move down and the break of structure. That is considered the breakout. And then what do we see next? We're waiting for the mitigation for price to tap us in and continue to the downside. What we want to do is get in on the mitigation. So let's see here. Bam. We just got tapped in, even though we're right here. Bam. Right after this candle broke structure to the downside, we got tapped in off of this wick once more. And then what happens? Let's say we targeted some structure low down here. Some structure low down here. Bam. We get the nice mitigation and price gives us a nice rejection to the downside. All of this is ours. Now you could have targeted this low right here, but at this point, once price broke this, I probably would have taken profit at this low right here. So this would have been a nice clean trade, right? So I hope this is making sense for you guys. We get the manipulation, we get the liquidation, right? I'm showing you guys exactly what's going on with Wyckoff, a simplified approach to Wyckoff. Manipulation, liquidation, breakout, mitigation. Instead of having to label every single part of Wyckoff, right? We don't have to do that. It's doing too much. We want to simplify trading as much as possible. Instead of having to label every single part of Wyckoff, the UTAD, the UT, the this, the that, all we have to figure out, all we have to understand is manipulation, check, liquidation, check, breakout, as I showed you guys, breakout, and then the mitigation. What we want to do is get in on the mitigation of the breakout. The mitigation is basically when price returns back to the last supply zone in this case, because we're looking for sells, and then we want to get in and then take price to the downside. So that's as simple as it gets. That's the simplest form of it. You don't have to remember every single part of this phase, right? All you have to do is remember manipulation, liquidation, breakout, mitigation. Even though we got stopped out on the first time, on the first liquidation, we were able to catch some pips and go break even, right? Partial and break even is better than getting stopped out. And even though we got broken even and we took some partial out of the market, we were able to re-enter the market and catch a much nicer trade with a better RR after, because we understand these principles right over here, right? We understand the principles. So if you put these four principles in your head, you do not have to remember all of these little parts of Wyckoff, all these little parts of the schematic. And then on top of that, not every time do you get the UTAD or the UT. So there are times where you're waiting for the UTAD and you might not get the UTAD. And because you're waiting for the UTAD, you miss out on the trade. That's the last thing you want to happen. Let's say this UTAD didn't happen and price fell from here. We were still able to get in on the UT because we followed the principle of manipulation, liquidation, breakout, mitigation. We followed that principle and price took us to the downside, which would have been beautiful. So let's take a look at a distributions, not a distribution, but an accumulation schematic. I found one actually down here. So that's the accumulation. Let's take a look at a distribution, or that was distribution. Let's take a look at accumulation. Same case the other way, guys. Same case the other way. Same case. Exactly the same case. So we're down over here. Drop down to the 5-minute. Again, we're going to keep these principles in mind as we're looking at price. Keep these principles in mind. So obviously we have some kind of manipulation happening here, right? We're anticipating for price to shoot up. Now this is a longer form, a longer stretch. This is going to require a lot of patience in this case because this happened over a period of time, probably over a day or so. So we got the selling climax, if you want to remember all that. We got the selling climax, the automatic rally. We got the ST. Let's see the accumulation schematic. We got the ST right here. Then we got the STB over here, as you see in the schematic picture. STB right here. And then finally, we get the test all the way over here and for price to continue to the upside. But because we know these 4 principles, we don't have to remember all this. We can easily get rid of this. We don't need all that, right? We just simply see, and to make it a lot easier for you guys, well, I'll show you guys that after. I'll show you guys a way you can make it even easier with changing the chart from candles to I think it was line. So I'll show you guys that later. But manipulation, we see manipulation happening. We see liquidations happening, right? Because buyers over here got liquidated. Buyers over here got liquidated once more. And then we see a breakout, right? We see a breakout. You could have gotten in on the mitigation of this demand zone. Beautiful, beautiful mitigation. Beautiful mitigation of this demand zone. Took you to the upside. Or if you want a better RR, you see you got liquidated on this one right here. As you see, let's put a line right here. This is actually liquidity. You got liquidated out of the market. If your stop loss was below there, liquidity low. And then what happens after this last liquidation? We get a breakout. Bam, we get a breakout. What happens after breakout? Mitigation. Because price has to come back. The banks have to come back to close out their orders. Get a nice mitigation. You could have taken it off of this demand zone right here. Or if you missed out on this mitigation, there's actually another chance for you to get in, right? We get the huge breakout. If you consider this the breakout, right? If you consider that breakout, nice mitigation on this demand zone right here. Beautiful, beautiful, beautiful. You could have gotten in right there if you wanted to. Still tapped into this trade. Very nice, very nice. So that's what I wanted to show you guys. And let me show you guys an easier way of looking at it. Let's actually go back to this schematic. So let's delete these because we don't need those. Simplified approach to Wyckoff, guys. So let's change this to a line graph. So this may or may not make it easier for you. If it does, good. If it doesn't, actually it doesn't make it easier because, well, it does. If it does, you can use it. If not, you don't have to. But as you can see the manipulation happening. You can see the liquidations happening. You can't really see the breakouts, but you can kind of, based on how much experience you have with trading, you can see that price broke out of this range right here. So price broke down below this low, and then you get another breakout down here, and you can't see the mitigation because there's a line graph. It just shows you straight lines. If you go back to candles, nice mitigation right over here. So that's what I wanted to show you guys. This is a simplified approach to Wyckoff. Remember the 4 principles, guys. Manipulation, liquidation, breakout, and mitigation. Say it with me: manipulation, liquidation, breakout, and mitigation. If you want to simplify your trading, this is a great way to look at things. All right, so I've been back testing this, I've been studying this, and it seems to work really well. The only thing is you have to be patient. In general, with trading, you have to be patient. So this doesn't change anything. This just makes it easier for you guys to not have to label every single part of Wyckoff. Simplify trading for yourselves, guys. Don't overcomplicate this because it's hard enough. I want to make things easier for you guys, and you should make things easier for yourselves as well. Remember, manipulation, liquidation, breakout, mitigation. See you guys in the next video. Peace out.